All right, let's go back to commodities, of course. But that's about sort of concurrent theme that we've been talking about. And where to get perspective? Well, we get that from Peter O'Connor. He's joining us from Shaw and Partners. Peter, a very good afternoon to you. Thanks for joining us. All right, so look, what is actually taking your attention at the moment? Because as we've just been talking about, there is so much to look at in the commodity sector. So what's catching your attention in particular?
Look, there's a lot of noise. So what I've tried to do is dissect what's happening out there and try and, as I wrote, get perspective on where we're at and where we go from here, because that's critical, not what's happened, but where we go. And I think there are key things that I'm looking at, and I think the key narratives that will drive us, not just for the next day or two or week or month, but for potentially years. Firstly, it's the great rotation. That money move out of tech into what I call the rust belt, the dirty value plays out there, which we last saw in 2000 through about 2007, post the tech boom in 2000. So we're starting to see that happening. It's been over the last few months in the US S&P, and that looks like it will play out, and it could be a multi-year journey. And one key indicator of that is the global commodities indices divided by the S&P 500 in the US, which that chart is plotting 50-year lows, and it's been low for about the last 3 or 4 years, so you could have called this early, but it does look like that's turning. So the rust belt, they're going to start to outperform the high PE stocks, the long duration stocks, and that's key. So that's the first part. It's about identifying that rotation and what's available. And then it's what's happening post the issues we've seen in COVID, but also more recently about the Ukraine and this dislocation of commodities potentially globally for a short-term and maybe even a medium, longer-term basis, as we see trade flows get reallocated based on what may or may not happen in Russia. And even if Russia was to walk away from the Ukraine tomorrow, the security of supply issue will drive a buying and a stockpile of material which we probably wouldn't have expected. So that's underlying commodities as well. So all of that means earnings going higher. If earnings are going higher, share prices go higher and valuations are higher as well. So thematically, that narrative is driving what could be a long journey for resources. Choppy and volatile as it always is, but potentially trending higher for quite a while. So although some of these commodities and names feel like they're printing highs, and for commodity price and equities, we are not there yet. There's still more to go.
So what then on the list looks cheap to you?
Oh, standouts for me starting at the big end. So the one I really like, and it's rallied, but it's still going further, South 32. Great story, a transformation of its portfolio, the best it's looked since 2015 when it spun off from BHP. And just the deleveraging alone in the next 4 months post its recent acquisition, we'll see it at about 45 cents a share, so another 10% from here. That's without any more commodity price upgrades. So South 32, key pick at the big end. The other one at the big end, which is not as good, bigger pick longer term, but just in the short term, this BHP sale of its oil division. It's incredible. Nobody's talking about it, but there's this pending deal where BHP will sell its business to Woodside, receive paper in exchange, and they'll be dividending that paper back to shareholders. At today's price of Woodside, that's worth $6.11 Australian per BHP share. That's a yield of, it's coming up around 12.5%, and that's just a one-off. Due out maybe late April, early May. So that's an extraordinary, nuanced, one-off dividend story. So if you want income and you want a story that's backed by commodities as well, going back to my earlier thoughts, BHP's in that very, very interesting space over the next couple of months. Then it follows up with a regular final dividend in August, paid in September. So BHP's yielding at the moment somewhere north of sort of getting close to 20%, which is just absurd. But that's another opportunity as well. And drilling down, what I like is the energy space. Oil, gas, coal, they're all doing well. And from the remarks of Elon Musk on the weekend about fossil fuels and that we need them in the short term to bridge the gap, that's put a support underneath these commodities as well. So they'll be around for a while. Even though they're on a slippery slope over the long term, they're still going to be here. So prices, as absurd as they look today for coal price, we could be seeing higher coal prices for a lot longer. So perhaps today's numbers won't be here for a long time, but the underlying numbers will be a lot higher. So printing cash is where they're at. And as an example, Whitehaven Coal, they're printing cash at such a level, their free cash flow yield will be about 180%, or a payback period on their enterprise value of less than 6 months. These numbers are just absurdly high, extraordinary. So that's a level across whether it's oil, gas, and the coal space, so, and dramatically underestimated by the market values of these companies as well. They've diverged from their underlying commodity prices. There's a huge opportunity there as well. And gold's starting to look really interesting over the last week, with real rates ticking lower sharply again. Now trading back around minus 1% on a real basis. That's very supportive for gold price. Not least, we've got the geopolitical support as well, which is always a bit once offish, but the real rates is key, and that will drive gold price as it has, and again today. And gold equities they're doing that today, delivering a much higher returns, and they're very levered, obviously, to the gold price. So gold names across the deck look interesting as well.
So, Peter, specifically those gold names, are you just looking at the larger caps, or are some of the smaller names starting to interest you now too?
No, across the board. So clearly, when you buy a sector, you want to buy leverage. So you drill down and you look at what's down there. Explorers are the way to get the maximum leverage, and we do look at some of those. So we've got Matador, which is an interesting exploration company out of in Canada. We've got Saturn, which is in Kalgoorlie, and a bunch of smaller names. And the mid-cap producing names where there's leverage there operationally and financially, it's the likes of St Barbara and also Regis. And at the big end, the one that stands out at the moment, which normally doesn't look as cheap as its big cap peers, is Evolution. It's looking really interesting versus Newcrest and Northern Star as well. Not least because it's got a huge byproduct credit of copper coming through this half based on its acquisition that it wrapped up early this year. So gold, there's opportunities across the deck, be it the small exploration end, mid-cap end, or even the big end, but there's leverage across that portfolio.
Pete, are you fully invested at the moment, or do you have any cash waiting spare in case things change?
Oh, that's a very good point. Depending who you are and what you do and what mandates you may or may not have. So it begs the question, if you did have cash, why do you have cash? Because you shouldn't have it, because inflation's gapping up, so you're going backwards on the back of that. So I'm assuming a smart investor would not be on cash, and if they were, they should be deploying it into some of these harder real assets. That's key at the moment. And if you don't have cash and you need to deploy, you need to look to take look at the relative opportunities. And in my sector alone, there are a few funding opportunities. Iron ore is the relative potential underperformer, seems to be one of those cases. And based on Elon Musk's comment over the weekend as well, maybe the lithium and those EV related stories may take a little bit of a back step, just whilst the fossil fuels and the Rust Belt commodities rally in the near term on the back of that need for fossil fuels, at least in the near term. So yeah, cash, deploy it. If you don't have cash, there's some opportunities, but it's harder to find shorts out there.
And Peter, is this all based now on what's going on in Ukraine and the duration of that conflict? If you're looking beyond that, will commodities then come off, to your feeling, and particularly energy?
Short answer, if the Ukraine situation was to be addressed immediately and the Russians pulled out immediately and we had peace, yes, that would see markets pull back, as they should. But then it would be how the commodity markets balance and how the world looks at commodity flows and commodity routes. And you would expect that the Europeans in particular would want to diversify and look at security of supply issues, and as a minimum stock or build stock to a level that they haven't had in the past to provide a buffer to any further disturbances in the future, and potentially look to diversify their supply elsewhere. So we're going to get this reshuffling of the deck, even if this Ukraine situation ended tomorrow. So Russia's big, as you know, in aluminium, in nickel, in platinum, in palladium, in coal, thermal coal and metallurgical coal, even in iron ore, given what they export and the quality they export. So that readdressing of the global supply balance is going to be critical, and I think even if the skirmishes in the war ended today, we'd still see commodity markets trading higher, perhaps not as high as they are right now though.